Minute pass, so we'll go ahead and get started. My name is Gunnar Fye. I am the Director of Operations here at Impact Wealth. And today we're going to be covering a webinar in a series that we started actually in the fourth quarter of last year. So this is our sixth webinar in this series. Uh, we have another one coming up on May 1st on legacy planning. So stay tuned for the invitation to watch that. You can also check out our website in our YouTube page for all the previous webinars that we've completed. All the recordings will be available for you to go back and watch in case you missed one or want to go back and rewatch a portion of it. You're more than welcome to do so. And today I've got the pleasure of introducing James Teagarden. He is the CEO and wealth advisor at Impact Wealth. And in today's webinar, he's going to be covering a topic regarding direct indexing. So as it relates to certainly the relevant time that we're in with tax season coming up, he's going to be covering some topics as it relates to how do we efficiently plan for taxes, ultimately to pay less over time. So he's got over 30 years of experience in the industry. And so without further ado, I'm going to kick it over to him.
Thank you, Gunner. If anyone is not aware, next week is April 15th, tax day, so an appropriate topic. We obviously spend a lot of time and energy trying to help our clients reduce taxation, lower risks, preserve and protect their wealth. And so it's an appropriate time to talk about this. We, as an independent financial planning based firm, wear a lot of hats. We've got a lot of partners that allow us to provide results that we think are very hard to find out there in the world of finance and investments. And I'll be talking a little bit about that. We have really three markets that we work with. They're all individuals and families. We don't manage any institutional money. So taxes are a big deal for everybody. Our primary market is our retirees and pre-retirees in that 55 to 75-year-old range, typically 2 to 10 million in net worth. Our business owner clients tend to be a little younger. I would say 45 to 65 generally, 10 to 30 million dollars of net worth or higher and growing. They have a little bit different needs and different goals. And then we deal with high net worth marketplace over 50 million in net worth. All of them are paying a sizable amount of taxes. So, what can we do? What can we control? We're going to talk about direct indexing today to help reduce taxes on an ongoing basis. And I think we review prospective clients' portfolios all the time, and a lot of them they may have a very, very diverse portfolio, different managers, different firms. And when we actually put all of their portfolios together, they're tracking the S&P 500 or they're tracking the S&P and the MSCI EFA. So they're already kind of getting that same risk reward profile. But we hear a lot about tax efficiency. We don't see it in action. And I ask our clients or our prospective clients when we start working with them is, do you know what you're paying in fees? Advisory fees, platform fees, custodial fees, manager fees, expense ratios? The answer generally is no. They certainly then don't know how much they're paying in taxes on their portfolio, and they generally don't have a plan for reducing those taxes. So I would say the marketplace generally underserves our client base, and that's one of the things we're trying to solve here. So, um, and so disclosures here, we're part of Madison Avenue Securities, a broker dealer out of California. We're also partners with Singe Advisory Group, about a $5 billion RIA firm out of Tampa, Florida. And we're also partnered with AE Wealth Management, about a $50 billion RIA out of Topeka, Kansas. And we manage and advise on a lot of money, but we couldn't do it without our partners. And of course, we get to put our disclosures up here. Investing has risk, et cetera, et cetera. So thank you for that. Actually, when we look at portfolio drag, obviously the lower your investment costs, the better, and also the lower your taxation, the better. And most investors focus on kind of gross performance. They don't really understand what's going on below the surface. So we say it doesn't matter what you earn, it matters what you keep. Even really uh, good, well-managed portfolios can lose significant amounts of values in taxation, rebalancing events, asset transitions, things like that. So, uh, investing has evolved tremendously. I got in this business in 1996. Um, and as what we've seen is the evolution of mutual funds to ETF to now what we're using a lot for taxable portfolios is direct indexing. And I would say that technology is key, and scale is key. And the only way we can accomplish these things are with our partners at Singe and AE Wealth Management and all of our money managers we work with. So, what is direct indexing? If you think simply put, let's just say that you wanted to track the S&P 500 or the NASDAQ or the MSCI EFA. And you could do that with an ETF to track that index over time. What our managers do is they say, hey, we can recreate the risk and reward profile of, let's just take the S&P 500 as a simple, most widely held index. And we can, the manager, uh, with between 40 and 60 individual securities, track the S&P's performance and the S&P's volatility and risk to a T. And by doing so, if they're managing those individual securities, it is then very easy for them on an ongoing basis, a daily, weekly, monthly basis, to look at the um, gains and losses in the portfolio and to sell securities off and replace those to tax loss harvests, offset gains. And if that's done appropriately over time, it can lead to a lot of savings. Okay. So ETFs and funds, obviously, hard to customize, limited tax control. It's just tough to really provide a lot of customization. Whereas direct indexing, if you have the individual stocks, fully customizable, active tax management is available. So even in a strong market, let's say some stocks are gaining and some stocks are losing. So if you look at the in various markets or various sectors at any given time, one security may be up and one security may be down. So the overall market may be continuously going up, but underlying that, there's a lot of volatility between markets, sectors, and individual securities. So basically, if a stock declines, we can sell at a loss. We can offset gains elsewhere, book those positions, harvest, and produce some tax efficiency. Okay. So uh, I'm going to look at this hidden return. We call it the tax alpha. So with one of our managers who's been doing this for the last 4 or 5 years in not in a small way, in a pretty large way. They've tracked their overall every single portfolio that they've been doing this direct indexing with tax loss overlay on, and they've found that tax alpha has ranged anywhere from a quarter percent a year up to almost 2% a year in any given year. So there is definitely tax savings. It's important to not only be able to do this, but also be able to track it. And then we're going to talk about the impact of that over time. And you can kind of see here, $100,000 over 30 years without that tax savings and with the tax savings. This gives you some hypothetical way to look at that. If you just took a $100,000 portfolio, it was earning 8% a year returns, and we've got 1% a year's tax savings. That $100,000 over 30 years, just the tax savings alone increases your overall gains from 466,000 to 760,000. So almost $300,000 on a very low starting base. You can also, I think, very uniquely, uh, we talk about direct indexing, and a lot of people just assume it's the S&P 500. We can customize portfolios around different market indices. Let's say we wanted 25% in large cap developed international. We could do a direct indexing portfolio on that. Let's say we didn't like the S&P 500 because it's cap weighted. We could do a S&P 500 equal weight, or we could do an S&P 1500 or a Russell 2000. So we can pretty much recreate whatever risk reward profile we want from an allocation perspective and do direct indexing on each of them. So um, we do see a lot of folks coming into us if they have substantial gains. A lot of times they'll have one or two stocks with large gains. We can actually move those positions in and manage around those over time to, effectively, if we can say, hey, what's our capital gains budget? What fits into the overall financial plan? We can then move them into a more diversified, hopefully higher returning asset base than sticking with the larger concentrated position. So, and do it all while we're maintaining that same risk reward of whatever or whatever index we want to match. So, who's this for, really? It's high income earners, high taxpayers, taxable investment accounts, investors with large capital gains exposure, long-term investors. This is largely, we're talking about long-term growth portfolios here. We're not talking about income portfolios. That's a whole different topic. But it's really for those folks who are paying a lot in taxes. We do manage a lot of money in family trusts where the highest marginal bracket is hit at like 14,000 a year of income. So if you have trusts with major amounts of money in them, very highly taxable, um, or you're just general taxable accounts. Okay. Not This doesn't really fit that well for small accounts, tax deferred IRA, 401k accounts, lower tax brackets. Okay. So I'd say in general, uh, at least $250,000 on up portfolios. And obviously the higher the taxation, the more savings we can get. So we talked a little bit about this, just fractional shares, automation technology, the managers being able to be efficient, speed, lower costs, a lot of that in our marketplace. We've been in the independent advisory space since 1998. That means that we have an independent broker dealer, independent RIA. We don't have a parent company like a wirehouse or an insurance company. And we've had, over time, the ability to, through entrepreneurship and technology advancements, provide results that are very difficult for the big players to do very well, especially in that middle market where I would say that $2 to $20 million type marketplace. So what are we doing? We're turning market volatility into a tax advantage. Instead of avoiding losses, let's leverage them. So um, if you want to learn more, obviously we can do one of our first steps is when we meet with someone is we tell them that if they can provide their basic financial information, their investment statements, insurance policies, annuities, etc., their tax returns, we will build out a initial base financial model to show them what their retirement looks like, to show them what their future looks like, and at the same time do an initial analysis, a fee, tax, and risk analysis on all their holdings. So we'll do that up front. So if you like what you hear, you want to hear more about how we help clients uh, lower taxation, reduce risks, and preserve and grow their wealth, let us know. You can call Gunner. You can email us here at gunner@impactwealth.com. And we appreciate it. I hope you all have a great weekend, Masters weekend, and hope you all go pay your taxes next week on the 15th. And So I will just open it up here, see if we have any questions in the chat or from the audience.
Yeah, it looks like we had a couple questions come in, Jim. The first one is, how does direct indexing compare to just owning a mutual fund or an ETF, specifically regarding the performance?
Yeah, so I think it's very easy to say, hey, this ETF is doing X, Y, and Z. Here's its risk reward profile. Okay. In general, what I'm suggesting to you is we're going to say, what index do you want to track? Okay. So you could have an S&P index fund, S&P 500 index fund. We can recreate that, or an S&P mutual fund for that matter. We can recreate that same risk reward profile and track to a T over time what that looks like. Okay. If you have individual managers that are managing money, they probably have a benchmark they're managing to. So we're saying, hey, we can manage to whatever overall index that you want from a risk and reward profile. But if we do that correctly, it's very spot on as to here's what the S&P 1500 did last year, and that portfolio does very, plus or minus 99% of that performance with the same risk. It's just that we're doing 40 to 60 individual securities at any given time, and then our managers are actually trading to capture the losses and offset gains. Okay.
Yeah, yep, that's good. And looks like we got one more question in here. And they're asking, if I've got a lot of embedded gains already currently in my portfolio, what would that look like? Moving to direct indexing and the tax consequences of doing so. How would you handle that?
Yeah, so it's something we deal with every day. We were on the phone with a client yesterday, had $250,000 in Apple and Meta, and wishes he sold it all 2 years ago. Didn't, but still has a huge gain. We've got another client who's got uh, 13 million in 7 stocks, all with very low basis, and it's a problem. It's like, okay, what do we do? And I think the bigger answer for us is we're not just we really have to understand the entire picture, goals and objectives, taxation, and income needs, et cetera. And then there are lots of ways we can help clients diversify out of big positions. I think the direct indexing, if we're managing to a certain risk reward profile with direct indexing, and we have a large block of a couple different securities with large gains, we can use a number of techniques to manage out of those positions, and they may go into this direct indexing going forward. Okay, they may go other places as well. So it's not directly the same, but you know, I would say 50% of our clients, our new clients that come in, have similar issues like that. Some of them we can get very, on really big gains. There's lots of there's charitable concepts that we use that can help. There's also other tax reduction strategies to offset those gains. We've talked a little bit about some of those in the past webinars. Um, or we can just set a budget and say, hey, over time, we're going to get out of this. We're going to recognize this amount of gain. And then with the rest of our portfolio, we can build that portfolio around that same risk reward profile while managing to the taxation we're pulling off of that, or to the taxes we're creating from getting out of the larger position. So,
Yeah, yeah, that's good. I would say specifically on that question, like Jim mentioned, we did do several webinars before addressing different tax strategies to save tax. So feel free to check out our website and our YouTube channel. You'll find information relating to those different strategies. And then ultimately, feel free to reach out to me at gunner@impactwealth.com, and we can find some time to talk and set up a conversation with the team to talk about your situation.
yeah, and I would say, generally speaking, if you're new to us, book a 20-minute intro call. And in that intro call, we're going to ask you some questions. You're going to ask us some questions. We'll tell you kind of how we work. If you like that, what you hear at that point in time, we're going to talk about setting up a second meeting. That second meeting, we will have reviewed your portfolio, all your investments, your financial situation, your tax returns. And in that second meeting, we will outline and try to identify what your objectives are, some of the gaps, opportunities, and ways that we can help lower taxation, reduce risks, grow your wealth, et cetera. And then we'll talk about how we go forward from there. So we don't charge for that up front. I think an intro call is very helpful. You kind of get the gist of what we're talking about. We find out a little bit about you. That second meeting really is then an hour 15 minutes. And at that point in time, we'll decide if both mutually uh, how we might work best together from that point going forward. So that's Impact Wealth. We appreciate you all. Thank you for listening. We'll be doing another one May 1st, I think. So every 2 or 3 weeks, we're doing these webinar series. Gunnar, I don't think all of the past ones are on the website yet, but they will be coming soon, folks. And we do have them available on YouTube. We can shoot out a link or something like that, I believe, as well, right?
Yep.
Okay.
Yep.
Good. Great. Thank you all. Have a great weekend and hope to hear from you soon. Thanks.